Guys,
tool?
I'm getting some feedback that the link is not working.
Okay,
Yeah, I had to type in the actual meeting ID and that worked.
huh. Do you want me to text it to you, Art?
So you can forward it. Yeah,
Yes,
text it
please.
to him.
Okay.
All right, we're gonna let people in. We got 29 people in the waiting room.
I'm gonna admit all. Um, yeah, Zoom link isn't working.
Boom, boom, boom. All right, welcome everyone. You guys can probably hear me. We're waiting to just get a couple technical difficulties um, handled. So thanks for jumping on right on time. And we will get started in 1 minute. Claudia, are we live on Facebook? Yeah? Cool. Perfect. Thank you. All right. So there's some people in the waiting room and we're getting the link out to everyone. I guess there are some issues with uh, Zoom link, but here we are. All right. Um, who's taking care of the waiting room? Because I see some people waiting in there. So you guys could figure it out, Claudia and Vanessa, who's working on what. Thanks. All
Yeah,
right.
go ahead. Get
Cool.
started.
All right, let's go ahead and get going. Welcome everyone. Today is the 30th of January, 2025. Time flies. Time really flies. It's Thursday, 6:30, and we're here for our annual State of the Market address. It's always really good. It's always a great time, and I'm excited about this one. Why? Because just like probably every other year, it's like there's a lot of uncertainty. There's a lot of things that we don't know what's going to happen, right? And some people get scared, especially if our money's on the line, right? We all have investments, whether it's um, real estate, stock market, crypto, you name it. We're all invested in something, some of us cash, and we got to know what to do with that. And so that's why we put on this event. That way, everybody kind of I would say has an education so they can make the proper decisions for yourself and your family. So thank you for jumping on. My name is Voltaire Lepe, and this is the state of the market. So I'm just going to kind of share with you guys what's going to happen. We have our speakers here. We're going to start off with Philip. He's going to be talking about the economy and stock market. And then we have Marco Alvarez. He's going to be talking about something that a lot of people really want to learn, and that is fire insurance, right? That's super important right now. What's going to happen in the state of California and San Diego in general. Long time uh, home insurance expert. And then we have Art Aguirre. He's going to be talking about mortgages and what's going on the mortgage side and interest rates. A lot of people are affected by interest rates, obviously. And Jesse Lipscomb, he's going to be talking about overall tax reform and all these rumors and what's going to happen there. And that's how that tax implications are going to affect our wallet, our bottom line. So that's going to be really good. And then Abe Lopez, he's with us, a repeat guest as well. He's going to be talking about construction and zoning laws and how that's going to impact our communities and our neighborhoods with parking and with more people living in a closer vicinity. And so that's what's happening today. And then obviously I'm going to finish at the end with real estate, what's going on, where we've been, and I think where we're going. So we're going to be talking about that. So without further ado, well, actually, let me just tell you a little bit about myself, I guess. Born and raised here in San Diego, and I am a real estate broker, property manager, and I'm up to 56 doors that I own. So I'm a property owner here in San Diego as well, coach and mentor, and that's what I do for a living. I'm a professional real estate person, and it's brought to you today by Lepe Tendwell Group, powered by EXP. So these are all the amazing agents. So feel free to reach out to the agent who invited you, give them big props because, without them, we couldn't put this together. So, And if you see here towards the bottom, you see Claudia. She's our co-host today. Thank you, Claudia, for being here. And then we have Vanessa as well. She's the one that put on this event and helped coordinate everything. So thank you both for being here. And if you think this is a great event, please leave us a review and just say that you were on here and what you learned, and it'll help us online with future customers. All right, so here we go. Philip Simmons, you're up, wealth strategist. Great photo, by the way. Uh, so feel free to go ahead and take over the Zoom
Okay.
and show us what you got.
Yeah, well, good evening, everybody. Voltaire, thanks for having me again, man. This is a great event. I always appreciate you inviting us to this, and ATS and all those in our office really look at you as really a pillar in the community as far as real estate, and so I just want to say thank you again. So my name is Philip Simmons.
Thank you.
I'm a wealth strategist with ATS Financial here in Sereno Valley. We do advanced estate planning. A lot of times you'll meet financial advisors who are really just focused on investing. But what we say is, anybody can make money. That's really half the battle. Protecting it, preserving it, knowing how to navigate the tax law changes and the political environments really makes us a specialty. So today I'm just going to kind of walk you through what we've seen, kind of where we are here today, and then what we anticipate going forward and some things that you guys may want to think about as you yourselves enter into the market or continue to build on your market returns. Okay. So the first thing I wanted to kind of walk you through, and you guys can pull this up yourself. So this is nothing new. This is just a Yahoo chart of the S&P 500 index. And what I did here is I wanted to kind of take a historical look at things because we've had a phenomenal 2-year run, was what we consider a bull market. And just by definition, so bull market is 20% growth from its recent down. If you look here, going to the far left, this is the start of 2022. And so many of you guys remember, oh, actually, hold on. Let me adjust that one more time. Looks like it misadjusted. January 1. Sorry about that.
And while you're adjusting that, Philip, why are you even looking at the S&P 500? Like why is that even important? Like what does that signify or what does it kind of show us about the US economy?
Absolutely. Very good question there, Voltaire. So the reason why we use the S&P 500 index as kind of a benchmark on what's happening in the financial world, simply because it has the top 500 companies in America. So the Standard and Poor's, that's what S&P stands for, is a group of individuals who actually curate that entire index on a regular basis. So they're removing companies who don't fit a certain market cap, that don't fit the criteria. So you're always looking at the best companies in America. So that's why we use the S&P 500 as kind of the broader barometer on where the financial market is going. So once
Got it.
again, on the far left here, you see this was the downturn in 2020 or 2022, excuse me. Inflation was high. People were uncertain about where the world was going, uncertain where the economy was going. And that really ruffled a lot of feathers. In that year, just in 2022, we were down 19.9%. Okay. 20% loss from the beginning of January all the way to the end of December. However, at the turn of the year, we started to see this new advancement in technology. And typically you see that as a catalyst a lot of times when the markets begin to shift, is there's just a new entrant into the game. So right there in January of 2023, that's when we really had the proliferation of AI. Many of you are probably using that in your daily work. And that has really ushered in a whole new era. Think of the .com, if some of you are old enough to think about that era. The new AI and advancement really tailored towards the technology companies in 2023. So you saw really those companies, and they called them the Magnificent Seven at the time: Apple, Microsoft, Tesla, Google, Facebook, so forth. And they really took this AI all the way through the roof. Now, in October, this was when everything began to slide because we started talking about the political changes in the political environment. Nevertheless, before we ended the year, you can see in that fourth quarter, there was a huge run up on business just recalibrating how efficient companies can be when they utilize AI. So in 2023, we had the entire technology company really push forward as far as the market's concerned. That really was they accounted for something like 80% of the growth 7 companies, 80% of the growth in 2023. Then we got to 2024 and people started to realize that AI isn't just for the technology companies. It also broadens out to your mom and pop shops, to your Walmarts, your standard needs and necessity companies that we see every day. And so we started to see a broadening out of the market. And what I mean by that, as I said, is instead of being growth companies, you start to see value companies. One's companies that focus on dividends, paying their investors for sticking with them over the long term. Okay. And so that really escalated the gains. Now we've continued in this bull market and will continue in this bull market as we usher into 2025. But I'm going to go into a quick PowerPoint to kind of talk about what you want to be wary of as we do look forward and look ahead to the new year. So let me go ahead and put this in
Cool.
presentation
And
mode.
it's got to be quick.
Yep. So as Voltaire has mentioned before, knowledge is power, makes you guys continue to educate yourself. Here's a quick reflection of what I just talked about. This was the 2024 S&P 500 index on the left, Dow Jones on the right. Dow Jones value companies focused on dividends, S&P 500 companies focused on growth. Here is the story that we saw in 2022 and the reason why 2023 was so great. In 2022, you had this rise in inflation. We hit a peak of 9% at one point. Really dampened people's pockets. Whether you were trying to buy a house, whether you were trying to shop for eggs, whether you were trying to buy groceries, you were hurt. 2023, that inflation came down, and that's what also supported the growth in 2023 and therefore in 2024. You all know, and I'll leave this to the mortgage gentleman to talk about how interest rates are coming down. We do anticipate 2 rate cuts this year, probably not until June or December. Still waiting on Trump to decide what kind of tariffs he's going to put in place. These are treasury rates. I use these as cash equivalents. So when you're looking and shopping for what places to park your cash, these are what bond funds are doing right now. So if you're at the bank and you're getting anything less than that, you should move it over to a low risk investment like bonds where you can get a decent amount of rate for parking cash. Now, what we're looking at into 2025 is, of course, everything that comes along with the winds of change across the White House. You have geopolitical risk. Obviously, the rhetoric in which our new president is talking to other countries does create a lot of uncertainty. What follows uncertainty? Volatility. Investors and the market does not like not knowing. And therefore, we anticipate this to be a softer year. Not to say we're bearish, not to say that the market is going to be down, but you need to be prepared for a lot of geopolitical unrest, whether it's Canada, Mexico, right at our borders, or further across the pond in Europe, even over east in China. So like I mentioned, we are going to continue on a bull market. The reason for that is while we have this uncertainty around geopolitical risk, that is just one risk when it comes to investing in the stock market. What you got to pay attention to is the underlying economy, which for the time being is a very, very strong economy. We not only have GDP on a consistent basis posting positive gains, but we also have full employment and inflation is still coming down. So these are the things that are going to really usher in the bull market. Now you're going to see volatility from companies. By the way, Microsoft was down 6% today. So look for buying opportunities like that.
Wow.
Key takeaways, so we can finish up here. 2024, 2023 were some phenomenal years, 20+% growth in the broader index. The Federal Reserve is reducing their interest rates. We anticipate 2 this year, but that could also change with the president that we have at the helm. Inflation pressures do remain stubborn. I think a lot of us are feeling the impact of the chicken flu, and that has put egg prices through the roof. I think we're paying $11 per carton now. So be wary about inflation and know that the market will take that into consideration, but a lot of that's going to bear the burden. The Federal Reserve is going to bear the burden of that. So again, 2025 brings about a host of changes, primarily from the White House. The uncertainty marks a lot of volatility. So look for buying opportunities when you see these extreme pullbacks and just be prepared to stay invested. One of the things the worst thing that you can do when it comes to investing in the stock market is trying to time the market. There's not been one oracle, even of Omaha, who's been able to time the market. What he has done He's bought in good, solid companies and held them long term.
Yeah, that's awesome. Thank you. And so you're saying 2025 is going to be a bull market to stay in the game and to buy stocks whenever they dip. And how much of a dip, what percentage of a dip like do you guys
So
usually buy?
yeah, so when we're looking at intraday trading, okay, so again, when we talk about buying the dip, anytime you see a company that is greater than a 5% loss in any one day, utilize that as a buying opportunity. Again, I bring up the case of Microsoft. Today, Microsoft is down 6%. Why? They beat on their earnings call every line that they could, except for one. Their guidance on cloud infrastructure was soft, not negative, soft. That's the word that they use, and that caused a slide in Microsoft. Is Microsoft going anywhere? Raise your hand if you're using a Microsoft computer. So Microsoft is one of those behemoths that is not going to leave the market. Therefore, you look at that as buying a down 6%, it's an oversell. So what you do is you buy at that low, wait till it pops, and it'll come back a few percentage points in the next day.
Wow. Okay. Well, I wasn't expecting good news as far as the bull market because I'm invested, so that's good news for me, and I think that's good news for the country, right? The overall economy whenever things go up. So, what questions do we have for Philip in regards to his presentation and the overall economy and stock market? You guys could either unmute yourselves or just throw it in the chat or raise your hand.
Looks like I have a question from Caitlin. I'm curious if you ever pair people with life insurance indexing capabilities. Caitlin, there's a lot of different strategies when it comes to utilizing or leveraging life insurance. A lot of the times we do that in our office as a legacy strategy, which means we're trying to trying to take wealth and create it for multiple generations. Typically, when you're dealing with insurance, life insurance, you are only able to buy the mutual funds, and we prefer to defer to the index. There are other mutual funds that life insurance companies offer, but at the end of the day, when you're looking at a legacy strategy that's supposed to span multiple generations, you're going to find that the index can outpace a lot of the different mutual funds given their fees over the course of those several decades. I hope that answers the question.
Cool. Let me see. I'm trying to mute myself, but it won't let me. What are your opinions with the new DeepSeek AI that really affected the stock market last week?
Yeah, thank you, Francisco, for that question. I get a lot of that from clients recently. There was this DeepSeek AI feature or company that came out recently, and it really rattled the technology sector on Monday. NVIDIA was down 16% in one day. Again, screaming buying opportunity. So to answer your question more plainly, we're not concerned. There always results good things from competition. What it is a matter of understanding and educating yourself on each of the AI strategies and what their expertise is. A lot of these companies aren't just an AI one fits all. Some of them are used for public use, like ChatGPT. Some of them are actually co-pilots, like Microsoft. Some of them are Gemini for search. So there's all these other different applications that are becoming more well known. So I just would suggest educating yourselves on what that AI is specific to, and then just picking the one that you feel aligns with where you want to go long term.
Cool. Yeah, awesome answer. Thank you. And by the way, if you guys want to turn on your cameras, I've seen you in person. I know how you look. It's all good. No judgment
Sorry,
here.
I had it turned off. I guess I got too secure with everyone. I turned their mics and I guess video off, but turn
Oh,
them on. You guys can turn them on now.
all right. Cool. Cool. Awesome.
It looks like,
Um,
I'm sorry, Voltaire, it looks like
go
we
ahead.
have last question.
Sure.
I'm sorry if I'm pronouncing this incorrectly. Shoberas. What's the app or platform do you recommend to invest in stocks? Really, at this day and age, they are a lot of them the same. I personally trade on Schwab. It's just been it's one of the behemoths in the industry, and it just has a lot of resources available, a lot of capabilities and utilities you can utilize. But do your due diligence. Do call these companies. Do explore with them. Talk to them. Ask them the questions. There's not any one that's better than the other, in my opinion. It's just one that you're most comfortable with.
Yeah, and I'll second that. I use Schwab. It's so easy. I like it. It's enjoyable to use. Um, cool. Well, hey, Philip, thank you so much. Appreciate you jumping on and I mean, you gave us some good news. I wasn't expecting it, man. I was looking for the doom and gloom, but maybe another presenter might give us that tonight. We'll see. Cool. And if you guys want any information, have any questions for Philip, just shoot him a DM, and actually Claudia or Vanessa is gonna post his information in the chat. Thank you guys.
Yeah,
All
thank
right.
you.
Thank
Cool.
you.
So now we're gonna just, some of you guys just jumped on. I'm just gonna go ahead and share this again. Thanks to our realtors at Lepe Tendwell Properties. We appreciate you guys. And if your realtor invited you, please reach out to them and say thank you. Okay. Now we're gonna go to the next presenter, and it's actually gonna be Ray with Farmers Insurance. Ray, what's up, man? It's good to see you. And if you want to mute yourself, that'll be great. And then that we could hear you, and we could put a. There we go.
There we
What's
go.
up?
I was having a little bit of trouble with my camera, but I didn't want to show my face, but okay. If I have to,
Hey,
I have to.
you have
Um,
to. You have to. All right. So, Ray, he's going to talk to us about what's going on in the world of insurance. It's been a scary time, especially with the LA fires. We've all seen, I think, and read stories about how these giant insurance companies have canceled fire insurance, um, policies on people before the fires or after the fires. So, and we all, if we're all property owners, a lot of us are, we've seen the rise of insurance just go through the roof over the last several years. So it's scary. We don't know what's happening. So Ray's going to shed light. And Ray, take it over. And you have the capability to share your screen as well if you want to show us anything out there.
I, I'm filling in for Marco today, and I want to first and foremost apologize to everybody that I'm not as prepared as I would have wanted to, but I think what I could share will be very helpful information.
Cool. Let's do it.
And so basically, as I want to start off with, most of you know, we had the Border 2 fire, and that was really scary, because it was happening in our own backyards, right? But right now, that's it's contained 100%. Evacuation orders have been lifted. I'm sure a lot of you already know that. But what you probably didn't know was that insurance companies started putting moratoriums. And they probably even today, I didn't check to see if farmers had lifted those moratoriums on some of those zip codes where the Border 2 fire was occurring or even nearby. So, that's one thing that happens in the industry of insurance is when fires start, insurance companies start putting blocks on zip codes. And I've been getting a few calls from realtors and loan officers. Hey, Ray, could you check the zip code? See if we could even write insurance for this property. And I checked them, and lo and behold, this morning, those particular zip codes, which was the 91910 zip code, believe it or not, 92154 zip code, those insurance companies, including farmers, had a binding block on there.
So what you're saying is like some South Bay zip codes, South San Diego zip codes, people cannot bind brand new insurance policies. So if they're buying a house, farmers, one carrier is not giving out insurance policies. Is that accurate?
Correct. Yeah, that is correct. Farmers right now ours is going to be a temporary. I'm sure they're going to lift it. They're just waiting for they were waiting for the fires to be at 100% containment and evacuation orders lifted. So for the Border 2 fire, it looks like we might be back in business. I'm hoping that by tomorrow I could see it. I do have a few customers that want to bind their policies, but that leads me to what's going on in California.
Right.
Right now a lot of companies, as this past year or two, they've been pulling out. And what a lot of people don't realize is that it's not just you know, the insurance company saying, okay, well, I don't want to write business here in California. It's more of it's more of money. It's profitability, where insurance companies, they were undergoing some tremendous losses. They were at a 30% loss ratio, during some of the claims that they paid out. We had a whole town burned down a few years back, Paradise. I'm sure you know. So insurance companies paid a lot of money, and you know, they're highly regulated here in the state of California. So it's not like if they could raise rates so that they could make up some of those losses on the claims that they paid out, because the state of California has their hand all over it. Where there's a proposition that was voted some years back where insurance companies are only limited to, I believe it's 15% profit margin. So imagine the state of California telling you that you can't make more than 5% a profit on your business. So that's what happens to insurance companies. So the before the pandemic, insurance companies had been asking the state of California to let them raise rates, and the state wasn't budging. They weren't approving any rate changes or anything. So what happened? The insurance companies started leaving. The most famous one, State Farm. State Farm doesn't write homes in California. In July, they canceled, non-renewed a lot of their policies, and a lot of those homes were the Paradise homes. So, and a lot of those customers didn't have a choice but to go maybe to another company that was charging them maybe 2, 3, 4 times as much as what they were normally paying, or just if they couldn't find anything, they would go to California Fair Plan. But to tell you the truth, some of them just said, you know what, I'm not going to insure it. I own my house free and clear, and that's something that they opted to do. But really, insurance companies, left because it's a question of money, and insurability, because insurance companies even have insurance companies that back them up.
Yeah.
And those rates increase dramatically on them. So now they have all the claims, they have the cost of doing business going up for them. So they just said, forget it.
So
But
let me ask you a couple of questions,
yeah,
just so we could get a clear picture of what you're painting. So far what you painted is like the history of insurance in California, where at some point in history, uh, California voted in a law that would allow a government agency in California to limit the profitability of insurance companies, right? So that person that's in charge of all the insurance in California says this is the max that insurance companies could earn or make or charge or whatever. And then from there, a lot of insurance companies said, hey, well, we don't want to do business in California because it's not profitable. So State Farm and several others pulled out. And
right,
that's what caused, basically issues with insurance here for starters, which makes sense, right? Because I think if anyone, there's a lot of realtors here, Jesse's a tax person. So imagine Jesse's somebody telling, you or the state of California saying, hey, Jesse, you can't charge up to this amount, or you can't make this much profit, or even the realtors on this call, hey, you can't make, certain profit when you sell a house. Then a lot of people would just not want to work anymore. And that's kind of what it sounds like you're painting, right?
They're moving to Texas. We're working.
yeah. So, and you know what? And like I was mentioning, it goes further than that. Imagine if Jess is being told that he can't raise his rates because he's got to ask the state of California for permission.
Mm-hmm.
And that's and here's the state of California sitting on your request for 2, 3, 4 years. Oh, the pandemic is here, so you know what? We're not going to do anything right now. We're not going to let you guys raise rates. So and I'm not defending the insurance industry, even though I work for it.
It's too late. I already see the meme. Bittered insurance person defends why he's not writing helping
Ray,
Californians.
Right.
I got something for you. That's good, Ray. I just put this in the chat. In March of 2014, now I live on Honey Springs, which is basically Otay Lakes Road up the mountain. Okay. My house burned down to the ground on a just inexplicable fire. Okay. And I made a mistake that I want you to comment on, and it was a mistake I couldn't have possibly known. Okay. We had a ton of money to rebuild, no problem. We had $500,000 of displacement, which was, putting my family up in another property while we rebuilt. But I didn't know one of the fine lines. Farmers Insurance had given us 18 months of displacement. And you know what happened in month 19? By the way, I was purposely not spending that $500,000. Okay. We spent such a little amount of that trying to make sure we had enough time to rebuild. But it took almost 30 months to rebuild. And from month 19 to month 30, guess who got to pay a mortgage and a rent because our friends at Farmers weren't paying. So if you would, it would do
we
me
have a mad client.
Yeah.
great. It would make
Yeah.
my heart happy for you to let everybody know it's not just displacement, it's the time. And I don't know what that phrase is called, but I'm sure you do.
Right. It's basically the loss of use portion of your policy. So when you guys are looking at your policy, you're going to look at one of the coverages, and it's the loss of use. So basically, the insurance industries, and it's just, and I'm sorry to hear, Jess, that
I got a
happened
new
to you,
house, same way.
first and foremost, and even more that it was a farmer's insurance. But let me just broaden it a little bit, because it's not just farmer's insurance, because we write what we call, let's say, maybe your policy was an HO3 policy. So these HO3 policies, remember, once again, these are standard in the business. This is what the state of California has insurance companies write. This is something that and a lot of them have different little, I don't think the word perks in there, but coverages that differ from other policies. So those that loss of use amount is based on a percentage of the dwelling coverage. But yes, they do cap it out, but it's not only farmers, it's every insurance
No,
company.
what I'm saying, I don't care if there was Farmers. I'm just trying to say that it completely caught me off guard that there was a time limit of loss of use in addition to the dollar limit. Dollar limit, we were fine. We got jammed because we ran out of time. And had we known that, maybe we would have pushed the contractors more. I don't know, but I didn't know about it.
Yeah,
and
but
I'm sure many people have no idea.
Yeah, and that's super
Okay.
important. And I think, to for everybody on this call to know, that's why you need a pro, someone like Ray, who knows their stuff. They know the policy. So when you bind a policy, they could explain it to them. And I always recommend sitting down. I mean, I don't know how many times I've been to Ray's office where I'm like, I don't know how to read this thing. Tell me what this means, right? And tell me what I'm missing and what I should do. And that's when someone like Ray says, and Ray's told me several times, oh, dude, this liability isn't high enough, or this isn't high enough, or you should add this, or you shouldn't have that. So I think having a pro on your side, whether it's tax returns or real estate or insurance, for sure, we need someone like that. And later on, Ray, just tell me what you did with the bonus that from the money you kept from Jesse's property. But
Yeah,
we won't go into that right now.
Right.
All right. So you painted the story, basically California kind of screwed us over unintentionally, because obviously they were trying to save us money, but they didn't know the consequences of not allowing free business to flow, right? We're running up on time on this segment. Let's answer some questions in the chat. Unless there's anything else you want to add, we can answer some questions right now.
No. I could be here all night talking about insurance right now with everything that's going on. But if anybody wants to call me, Voltaire has my number. If you have any questions, I think what I want to end with is everybody check your policy. Check your coverages. Call your agent. Ask questions. A lot of the agents don't really communicate that well. Maybe they're overwhelmed. Maybe it's just what they do. Some of them do it really well. But I think it's in our best interest as consumers to ask questions, to check your policy, check your coverages, understand what replacement cost value is, and understand what actual cash value is. That's a very important topic to have an important discussion with your agent, and also understand claims, how claims hurt you, and to be able to understand your coverages a
Cool.
lot better. So I'll leave you with that.
Before you go, what's a California Fair Plan? What does it cover? Because we've all heard about it, but we don't know what it means. So just a quick 30-second synopsis on.
California Fair Plan, it's the last resort. If nobody wants to insure you, California Fair Plan is available. They'll take you. However, it's limited coverage. It only covers fire, vandalism, malicious mischief, wind, hail. It does cover personal property and whatnot, loss of use, but only for the covered peril of fire, or if it's the vandalism, malicious mischief. You won't have the coverages that a normal policy has. For example, liability. You won't have, theft coverage. If a pipe breaks in your house and damages your home with water damage, it doesn't have that coverage. We offer a difference in conditions policy, which is a companion policy to the California Fair Plan. So if you want to close escrow and you can't get insurance anywhere else, California Fair Plan is the best way to go right now.
Okay, cool. And it just, for the record, does not cover liability. So if you're a landlord, someone trips and falls, it won't cover you. California Fair Plan. So everybody needs to understand that. Last question comes from Memo, and it says, do you think that it's going to get continue to get increasingly more difficult to get insurance plans, or are we like basically, is this what it's going to be?
Let me plug in Farmers Insurance. I feel a little bad after Jess's comments, but
I'm sorry, brother. I didn't even know you're a Farmers guy.
I want to plug in Farmers in a way. Hands down, Farmers. They're a company we haven't left. We were still writing home policies, so we're still writing home policies. We're reopening up the market. We just reopened up the market for condos. You have to have an auto to write a condo, renters insurance. So Farmers has opened up the market there again here in California, and in March, through our Foremost company, Voltaire. You're very familiar with Foremost.
Yes.
It's a company of farmers. We're going to start writing non-owner occupied policies again, landlord policies, vacant. So if you do see that the market is opening up, it's only a few carriers, and I'm going to say it, Farmers is one of those few.
Got it. Okay, cool. And then if you could do me a favor, there's some questions in the chat. If you could just go through it and then reply to all, that way everyone could, see those questions and get those answers. Is that cool?
Sure. Yep.
Okay, cool. Well,
And
thank
I
you so much.
dropped his information on the chat too.
Okay, awesome. Thank you, Claudia. All right, Ray, nice job. Thank you so much for filling in.
Thank you, guys. Thank you, everybody.
Yeah, for sure. Thank you. Guys, that's a super important, insurance is scary stuff. You don't want to be left without having insurance. And of course, if you're buying a house, I mean, you need it. You're not going to be able to get a loan without it. Every lender is going to request it, but make sure you check your policy, run it by your insurance person, have them double check, make sure that you're covered. And if you have the Fair Plan, California Fair Plan, make sure you understand you don't have liability coverage. So if you have a dog, you have a pit bull, you have anything like that where somebody could get injured, make sure that you don't have any friends. Nobody comes over. It's just you going in and out of your house all day. That's it. So all right, dope. Thank you. Let's keep it pushing. Once more, Lepe Tendwell Property. Thank you to all the realtors. Again, if your realtor invited you, please leave them a 5-star review online. It's always going to be super helpful. Without them, this would not be possible. All right. Now, next, we're going to go with Arturo Aguirre, loan officer, senior loan officer. He had to throw that in there. You couldn't just say loan officer. Okay. I see you. Let's let's do it. Welcome.
Thank you guys for having me. So just a little bit about myself. I've been in the mortgage industry. I've been in the mortgage industry for 15 years. I've seen most all types of loan, conventional, VA, your traditional FHA, first-time home buyers, down payment assistance, down payment assistance. Yeah, so I've seen most of the usual stuff. I've done a lot of investment properties. So pretty knowledgeable in all kinds of mortgages. Mostly what I'm going to be focusing on today is rates, and what type of transactions we did compared to refinances, purchases, but mostly going to be focusing on rates because that's what a lot of people are questioning right now. So I'm gonna begin by talking about what the current rate looks like. And I put the current rates, which are typical three type of transactions, which is your FHA, your conventional, and your VA. So right now our FHA rate's at 6.125. Our conventional rate is 6.875, and our VA is 6.25. And I'm going to show you guys a graph on what rates have done in the previous years to guys have an understanding of what, where it's going and what it has done. So if you guys look at this graph, is the graph on? In the 1980s, rates were at 19%. That's crazy, right? 19%. That's what rates were in 1980. And if you guys look at this graph, there's a red line. That's pretty much your average rate, through from 1980 to current. So if you guys look at the current rate, we're pretty average, right? But I want to speak about, there was a time in 2010, 2012 where we had a crisis, right? When the banks were doing these stated loans and people lost their equity, and the values weren't there for them to refinance. So in 2012, we saw a period of rates really going down. And we also saw an opportunity for us as mortgage bankers to be able to refinance because rates were low. Because what they did is that they allowed clients that were not foreclosed or not short sale to refinance at a lower rate with very minimal documentation. So you guys might have had that opportunity where it was called the HARP program, where it allowed you to refinance without an appraisal, without a credit check. They just want to verify you had income, and they will allow you to refinance. So that's when the rates really started peaking down. And then there was another time, when the pandemic, rates were unseen. We saw them in the 2%, 3% rates. There were rates have never been seen before. And the reason they did that was to keep the economy going, right, during the pandemic. So those rates were never ever seen. So in 2000, you got that other, in 2021, after 2021, we started seeing rates slightly start picking up. But a lot of people were stuck on these 2%, 3% rates. And right now we're in the sixes, right? So a lot of people are saying, what's going on with rates? But that is an average rate. We are expecting rates to start coming back down. Right now, when we're seeing our purchase, we're seeing mostly purchase transactions. And I do want to add that when you're seeing a purchase transaction, guys, right now we're starting to see a lot of seller credits. We're starting to see price reductions in our negotiations. So I do feel like it's more of a buyer's market at the moment, just because you're starting to see these rate reductions. When we had this pandemic, with the rates at 2-3%, guys, there was about 50 offers in a property, right? So you were making offers and offers. There was a lot of demand, a lot of people wanting homes. So a lot of people were getting outbid. So right now, what I feel like, consumers are getting properties they want. They're getting rate reductions or price reductions, I'm sorry, and they're also getting seller credits. So that's what I do see in the market, with interest rates and what, mortgages is doing. All right, and then here was the volume for 2024. This is based off quarter 3. I don't have quarter 4. It's not available as of yet. There was 796,046 transactions in 2024. 683,000 were purchases and 113,000 were refinances. And then in overall in the nation, 5,100,000 were in the nation. 3,299,000 were purchases and 1,800,000 were refinances. And then, guys, here is the volume. So as you guys can see, 2021, there was a huge demand. That's when rates were really good. In 2022, there was still a bigger demand. 2023, we had a decrease. 2024, you guys, as mentioned, it was probably the same as 2023, but 2024, the data is still not available. What we're predicting in 2025, we're predicting just an increase. I do see more refinances popping up because, inflation is as I pull credit reports, inflation is a problem. A lot of people have credit card debt, so you're starting to see a lot of refinance transactions, a lot of home equity transactions. So you're starting to see more of those refinance transactions.
By the way, this I like this slide right here because it just shows how ugly it is out there if you're a real estate professional. I mean, compared to 2021, volume is way down. The number of people that are getting loans are way down. And shoot, it looks even scary. But okay, thank you. Yeah, thanks for this slide. Okay, continue.
Well, and guys, this is how interest rates affect your affordability. As I put a slide on the left what our current rate looks like, and then a slide on the right what the average rate looks like on the more on the average side. So if you guys look, there's a payment difference of $332 a month. But again, guys, I want to tell you guys when rates go to that right side of the scale, there's going to be a lot more demand and there's going to be a lot more competition. So if you guys can afford that $332 extra a month, I recommend you do it because you're actually getting the home you actually want. And then affordability in San Diego, guys, here is your average median household income. Your husband and wife bring in about 127,000, which is $10,583 a month. Usually they'll allow you to 47% of your income. After using that 47% of your income, you're going to be left over with $5,609 to pay off your cars, your credit cards, your other expenses like cable, your utilities. And then here's our prediction, guys. Fannie Mae saying by the end of the year or beginning of 2026, our rates are going to be 6.20. Freddie Mac is saying they're just going to go down gradually. And then the Mortgage Bankers Association is expecting 6.40 by the end of the year. And then Zillow is just saying they're going to decline. And when they start declining, guys, when rates start declining, the Federal Reserves are going to do it slow. Why? Because the banks will be at capacity if they do it. It just if they hit if rates just hit like 1% lower, they're going to impact the market. So what's going to happen is the market, the banks wouldn't be able to hold the capacity. So they're going to slowly doing it as we're starting to see it. We're already starting to see rates start dropping down. So they will be doing it slowly. I am expecting rates to be around 6.125 at the end of the year on a conventional loan. It's currently at 6.875.
Cool. All right, so you're thinking rates are going to drop. We're at 6.875 right now. You're saying they're going to be about 6.125, which would help a lot. What
Yeah.
questions do you guys have? Thank you so much, Art. What questions do you guys have about interest rates, mortgages this year? You mentioned that refinances were up, and I see that too because people are trying to tap into the equity of their home and they just don't know how to do it, and they're starting off with home equity lines of credit, which is actually an easy way to tap into the equity, and it's very inexpensive and cheap. You're seeing that, but are you seeing refinances yet where they're just getting rid of their 2-3% interest rate altogether?
Yeah, so just for example, guys, I helped out a client about 2 months ago. He combined all his debt and he got rid of that 3% interest rate. He went to 6.125, and because I combined all his debt, he was saving $800 a month
Wow.
because he put his
That's interesting. So you could get rid of your 2 or 3% interest rate so long, and it still makes sense. So long, you're you're paying off 20-30% credit card debt and medical debt and other things that are like way higher interest rate.
correct.
That's smart. That's pretty good. That's a good plan. Um, all right. Does anyone have any questions before we move on? Um, All right. If you do, just type it in. That way everybody gets to read the question and Art could respond to it. All right. Before we move on, thank you again to the Lepe Tendwell family. And please leave your agent a 5-star review if you found this helpful so far. Appreciate you guys. And you could just do a little screenshot there or just Google them online. All right. Next,
We do
we
have
have
a question. Oh,
oh, we have a question. All
Arturo,
right,
you want to answer that? That's an interesting question, brother.
go ahead. Let's do it. Does somebody want to read it to him? It says we're new to the home buying, but when is a good time to refinance? Is that the question you're talking about?
No,
oh
I'm
no,
saying,
Aussies.
what about selling and getting into a higher interest rate? That's an interesting question.
Okay,
Yes.
cool. Go ahead.
So it's gonna make sense. Obviously, your value is gonna be able to determine that because a lot of people grown their values so quickly, especially during the pandemic. So your net proceeds that what you can have is gonna be able to keep that like it's gonna be able to keep that monthly payment lower because of those net proceeds if you were to sell. So yes, if it makes sense because you're walking a lot with the huge net proceeds to carry on to the new mortgage, even though the rates are higher than the usual, definitely it would make sense.
Yeah, and obviously the lower the loan amount that you're paying off, the easier it is for to make sense. I have one of my properties, I have like whatever, a 3% interest rate ish, but it's the loan's only $200,000. So if I go and refinance and pick up a 6%, 7% interest rate, it's not going to affect me that much because the loan balance was so low, you know. So um, the next question is, we're new to home buying, but when is a good time to refinance?
So it's going to depend on how quickly the value goes up. And let's say, obviously what we're expecting, obviously at the end of the year, let's say you purchase a home right now at 6.875, and the rates obviously, just at the end of the year go to 5.875. The bank's only going to require 6 months of payment. So let's say you drop 1%. Well, it's going to make sense because let's say your loan amount's about 800,000. That's about a $700 difference on a month-to-month basis. So anytime after 6 months, you definitely want to be saving about 3/4 of the interest rate. So for example, if rates are 6.875, you want to go down to 6.125 for it to make sense. So definitely after 6 months payments, you can refinance.
So the answer is about 1% difference. If you could get it for
Correct.
1% lower, that's usually when it makes sense.
Correct.
And I'll add on to that answer really quickly. Whenever you refinance, it costs money. So let's just pretend that it costs $7,000 and you're going to save 700 bucks a month. So you do the math. 7,000 divided by 700, that's 10 payments. So in 10 payments, you'll break even. Everything after 10 payments, then it's all profit. So if you do the math and it's more than 2 years, 3 years, it might not make sense. You might just keep the same rate. But if you could pay it off or break even in 10 months, that's a great deal.
Voltaire, what I put there for Ozzy is from the tax side of the house. If you've got $500,000 of equity built up, you can sell it right now, take that money tax free, plus any other equity you have, and apply it to the new house. Plus, if you're over 50, you can transfer your property tax base on your primary, keep that property tax low too. So I like potentially what Ozzy's bringing up. That might be a good strategy if it pencils out.
Yeah. Yeah, good. Thank you for adding. And then the last question before we move on is the question of investing in real estate. How many times can we purchase investment properties using FHA loan? I hear up to 5 times.
No, so usually FHA just changed their guidelines. You got to be 100 miles away from your owner occupied property. So you actually, as long as you qualify for both mortgages, you'll be able to keep that FHA loan. But if you have an FHA currently, you have to be departing from that primary residence got to be 100 miles away. But as long as you qualify, yes, you can keep an FHA loan going as many times as you'd like. But you just got to
Cool.
qualify.
You just got to qualify. Cool. Thank you so much. Appreciate it. All right. And then there's a couple questions in there. Art, you could go in there and answer. Let's move on. Thank you so much. Appreciate it. If I had one of those buttons that just like does a round of applause, I would click it right now. All right, Jesse, you're up. Investment advisor and IRS enrolled agent. Welcome.
Hey man, thanks a lot. Listen, this is almost like Art's presentation part two. All
Cool.
right, because what I what I did here is I have observations from 24 and opportunities for 25, but you know, the orange tornado has only been in office 10 days, right? So there's no tax changes yet. Nobody thought that was funny. Not one person, nobody, not one person.
I
No?
did, but I just it's late. I forgot to laugh.
All right. All right.
I laughed
I thought it was
inside.
funny.
I laughed.
Man, I was bringing it. All right. So listen, the 20
AI failed you. The little search, like, what's a good joke to start off my presentation? No, just playing.
dude,
No, but
but no, for real, 2025 tax opportunities. Look, we're expecting the old tax brackets, which from 2018 till now been crazy low. We're expecting that to stick around. We're expecting to get 100% bonus depreciation again. Maybe they're going to eliminate tax and Social Security, maybe. And the Corporate Transparency Act, whether you have to file or not, is uncertain. But all this isn't actionable right now. So I felt that the most beneficial 10 minutes I could give you would be some observations I'm seeing about 2024. And it's breaking down to this. We specialize in tax planning for real estate agents, real estate investors. I have seen agents go from making $500,000 a year to $50,000 a year. I've seen agents have the best years of their life in the last 5 years. Why is that? What could possibly do that? Well, in Arturo's slides, he was showing how interest rates there was such a gigantic difference in mortgages from 21 to 22 to 23 to 24. And that has a lot to do with the fact that we are 2 or 3% interest. It also has to do with the fact that many real estate agents believe in this concept called by referral only, but they confuse what that means. It doesn't mean just hang out and wait to get referrals. The agents that are dominating right now are the ones that have robust prospecting, marketing, and partnering systems, that they're going out, they're hustling, they're creating relationships, they're doing kickoff meetings on the economy. You know what I'm saying? That, like, activity begets opportunity. And so the agents that I see that are thriving right now, they're really getting after it. The agents that are struggling, if they're really being honest with themselves, a lot of them are not putting the time, energy, and effort in that they need. And I'm not saying that the interest rates aren't a factor. I'm not saying that inventory isn't a factor. I'm just seeing that people are still thriving right now, and there has to be a reason for it.
and that's good feedback, because you look at hundreds, if not thousands, of tax returns, and you're able to see people's income
Oh
and
yeah.
how it fluctuates, and you're able to see, agents' income and like you said, real estate investor income. So you're seeing that people are still making money in this economy.
And Voltaire, one of in my practice, we set up corporations all the time. We set up retirement plans all the time. I still have clients that are putting hundreds of thousands of dollars a year away into their pension plans. The only way you can afford to do that is if your income's up. And so how are these agents continuing to keep their incomes high during, it's not even questionable. It's a lot harder to sell a mortgage at 7% than it is at 2.5%, right? But it also depends. Let's take a look at loan officers. We got a lot of clients that are loan officers as well. In Arturo's slide, when 65% of the business in 2021 is refinance business, and you focus all of your marketing efforts just on refis, hey man, live by the sword, die by the sword. Refinances dry up when it goes from 3% to 7%. And then you're like, what am I going to do? Well, again, you have to stay on top of growing your business. Maybe now you need to start reaching out with lender, or excuse me, not lenders, but builders. I think that lenders really need to embrace things called DSCR loans. I think that's the biggest home run out there right now. Okay. And just not to steal your thunder, but it's a loan for real estate investors that if the rents cover principal, interest, tax, insurance, and homeowners association at least 1-to-1, sometimes more, but at least that, and you've got 30% down and you've got reserves, it's a loan on the property more than on you. And I'm seeing real estate investors continue to thrive on that. Okay. It's funny that I've got certain clients who may not show a lot of income on their tax return because we're offsetting it with pensions and depreciation, whatever else, but they're still actively acquiring real estate right now because of these DSCR loans. And I'm sure Arturo can talk to you about that. And that actually goes into the next bullet point on my observations. Real estate investors find a way to make money in low interest rate environments and high interest rate environments. At the end of the day, if the property cash flows, it cash flows, right? So, you know, I've seen a lot of clients doing some version of a BRRRR, buying with hard money, renovating, refinancing in the DSCR, then renting it out, and then waiting it out, 1031 exchanging later.
Right.
So, you know, and then you compare that with, okay, well, San Diego inventory is kind of low. Okay, well, maybe you got to invest out of state, right? So that those are, it's really, from my, like, your tax person is the person that you show all of your cards to, right? I'm seeing how they're doing in their business. I'm seeing how they're doing in their rental properties. And it's really interesting to see how some people pivot to the current situations and some don't, and the results that come with that.
Cool.
Yeah, man.
All right.
And I don't hate farmers insurance. I just wanted to let everybody know that you got to make
okay.
sure the time deductible on that.
You got to let it out one, you know, sometimes. So you did it
I just had
tonight
to.
in front
I
of,
was just trying to help. I was
70
just trying to
people.
help.
It's all good. All right, cool. So
I'm okay
90
with the
people
dad.
in front of 90 people.
90 people. So in regards to the tax situation this year with the orange tornado, as you called them,
Isn't that
what
funny? I think that's hilarious.
it is. I told you it was. And we have a bunch of LOLs in the chat, but
Thank you, guys. Thank you.
yeah. So what's the biggest opportunity you think, like if one of these tax things go through, and we only have a couple minutes left, but like
Well,
what
so
would
the
you see?
home run for me,
Mm-hmm.
home run is getting 100% bonus depreciation back.
Okay.
That it's such a slam dunk. If you're a real estate investor, I mean, here's a crazy strategy, but it works. Let's say that you're in your 70s and you've got a bunch of money in IRAs. Okay. You understand when you take money out of your IRA, you've got to pay taxes on it. Okay.
Okay. Mm-hmm.
If we can justify that you are a real estate investor, okay. By the way, one rental probably doesn't justify it, but a bunch does. What if you took out $300,000 of your IRA taxable income, and then you could get $300,000 of immediate depreciation by putting that down on $1 million house? That equals zero taxes. Okay, that is one of the three core or fundamental tax strategies we utilize of depreciation, because that is how rich people get richer. If you ever really sit down and you're like, man, how do I pay no taxes? Very simple answer, super simple. Get rich in real estate. If you've got a lot of rental properties, I mean, obviously you got to do it right, but depreciation will typically wipe out all of your taxable income.
Cool. Well, I look forward to that 100% bonus depreciation because I used it while it was around, and now it's less.
Yeah, you did.
And I look forward to using it again. By the way,
Cool.
is it going to be retroactive or just?
If I was a gambling man, I'm thinking 1/1/25. I don't think it's 24.
Okay, cool. Well, maybe if it isn't, then I'm buying some more rentals this year.
Yeah, I think seriously, I think people are just waiting right now. And I
Mhm.
think as soon as some of these laws that impact taxes, right? Because you can only do so much with an executive order. It has to go through Congress. It has
Right.
to be a law. But then it's just run as soon as these go through. Q1, Q2 probably.
And if you're a real estate investor, buy more properties if that happens. And if you're a real estate advisor or a realtor, you got to learn the investment game so you could sell a lot of those and then earn yourself a nice income.
Voltaire, it goes back to knowing your target market. You know, if you're going through single family residences with owner occupied, that there's nothing wrong with that. That's a good market. But I've had agents go do non-owner occ out of state. Think about that. Now you're looking at 1031 opportunities. You're looking at, people being out of state, not understanding the California market, selling it, having huge capital gains, having the opportunity to buy it. I mean, there's all kinds of stuff to do.
Okay, cool. Sounds good. Well, I appreciate it. We have one
Yeah,
question for you.
Oh,
It says, I'm doing rapid amounts of valuation for clients looking to re-up on their insurance coverage. Is the current of increase actualized in this tax year? And how does the increase of insurance play with writing off depreciation?
well, that is a heavy question. Here's the deal. They're related, but not really. Okay, let's focus on if it's your primary residence, you get nothing.
No
Just nothing.
depreciation. Correct.
Well, you don't get depreciation. You don't get to write off their insurance either.
Okay, got it.
Okay, if it's a rental property, okay, and I'm doing rapid amounts of valuation for clients looking to re-up on their insurance coverage. So here's the deal: you buy a house, the depreciation for tax purposes is based upon the acquisition cost plus improvements. It has nothing to do with the current market value. Okay, so as an insurance agent is trying to get the right replacement coverage for the property, it really doesn't have any impact on the taxes other than the fact that they're going to pay a greater premium, and that greater premium on your tax return is deductible if it's a rental.
Cool. All right. Thank you so much. I
Yeah, man.
appreciate it. Jesse's info's in the chat, and now we're gonna move on to the next presenter. And before we do, let me just again shout out the agents. Thank you so much for you guys, and leave them a review. Go on their website, Google them, or you could come here and leave us a review and just let us know that you learned tonight, and let everybody else know. Our next presenters, Abelardo Lopez, founder and designer of Abe Design Studio. Welcome, Abe. I'm really excited to hear what you have for us, because you're in a unique position of dealing with a lot of developers, a lot of property owners who are looking to build and construct and are dealing with zoning and all these things. And those are real things that actually impact us on a day-to-day basis, whether it's traffic, whether it's the number of people moving into our neighborhood, and whether it's what we get to look at. Do we get to look at beautiful buildings or really ugly buildings on our day-to-day? So thank you for joining us.
Thank you so much for inviting me.
Of course.
A little bit about myself. I have a master's degree in real estate development. I've been doing this for a little bit over 2 decades. I'm also a developer. I'm also an investor. And I have helped you, Voltaire, and other try to create more wealth and do investments. So I'm going to show you a little bit about what's going on right now. Give me a second. So first of all, I'm going to start with how everything is changing on the number of people in the families. Right now, these programs that I'm going to show you and what I'm going to talk about is San Diego is trying to keep people in California. All the state is changing these laws to keep people in California. That's why we have so many ADUs, SB9s, bonus densities, affordable housing, everything. But families are changing drastically. Now, I've seen a lot of projects recently that I go and they're 1-bedroom apartment units or studios. And I've seen a lot of people living by themselves with a pet. So we are decreasing on population. Now, this affects on the income, and this affects Arturo, for example, on the loans, because the less people on the household and they make less money, they have less power to buy something. And basically, if you have like a couple with a kid, the average income is $120,000 a year. So this will affect everywhere. So this is San Francisco. You see a decline of people, like there's less people in the same houses. Now, how this affect us? We have a shortage of housing in California, okay? So it says that we need around 171,000 units in 2029. And California wants to do 100,000 of those affordable so people can stay in the state. Okay, so they're giving so many incentives for you to build so many units because cannot keep up with demand. And now with the fires in LA, more people are going to look for housing and prices are going to go to the roof for rents and stuff like that. Okay, so we're not permitting enough houses today. We are not jumping to do more houses. People are waiting for the right moment. And this is the right moment to build. And this is the right moment to buy a property. Everybody gets afraid of what the interest rate, but it's a time to buy. Now, let me just show you this. You can see this, how the interest rate went up and the ADUs went down. You can build ADUs and they give you so many incentives to do ADUs. You can encroach the setbacks. You can do 2 ADUs in any property, residential house in California. And in San Diego, the city of San Diego, they give you affordable ADUs, bonus density, and you can put more units. And we're not getting enough units. Okay. So this is just the charts just to tell you how many units have been permitted since this program started till today. So you can see San Diego is doing great, but our other cities, they're not moving too fast.
How long is this show? How many years?
This is since 2018.
Wow. Okay.
So just to give you an example, Coronado is one of the worst cities to pull a permit on an ADU. They're gonna make you suffer to get an ADU. It takes like a year to get an ADU. Okay, so the state has these different programs. It has the SB9 program that you can split a lot into two, create 2 duplexes on each lot. You can keep the same lot and then do a duplex plus 2 ADUs. We also have the ADU programs. You can do a junior suite and an ADU in your house. You can also do affordable housing. They can give you 25% bonus density to 100% bonus density in the properties. We have opportunity zones that you can build with capital gains without paying taxes. Jesse can tell you about this. And then you have in San Diego City, you can do ADU bonus density. So for any affordable ADU, they give you another ADU until your cap on the FAR and the floor area ratio. You also have complete communities that you can go through the roof on structures and affordable housing too. So we have all these programs to do more units. Now, what's going on with this? Oh, I think I jumped a few. Time. It takes forever to do permits today. We have a lot of combinations for permits. One, we have new blood review and plant permits. Second, they have added more red lines and more red tape to pull a permit. The fire departments are becoming stricter. Of course, with what happened in LA, it's worse and it's taken really, really long to get a permit. And this is, the average time per city to pull a permit, okay? So you can see like Coronado and Del Mar, it's almost a year to put a residential permit.
And these numbers are like if everything's done perfect, because this is not my experience, right? Like this is like an ideal situation, or is these like real numbers on average?
Iteration. So,
Okay.
so just to give you an example, you hire the designer or the architect, it takes 6 weeks to do the design, then it takes 4 weeks to get the structural engineer, you submit for the permits. Then from that moment you're submitting the permits, you can take up to 6 months to pull a permit.
Okay, that makes sense.
So
That makes sense.
everything can be complicated if you have a septic system, if you are really far away and in a fire zone, if you're in a flood zone, if you're in an earthquake zoning that you need a trench, everything can change. This is an average for residential. If you're doing multifamily, it's gonna take longer than this. Okay. Now, the idea is in 2033, they're gonna focus more housing in these red spots and these blue areas where the transit communications are higher. The goal is to eliminate the cars. The goal is to have more subways or trolleys and more electric bikes, and people just move closer to the city. So that's what they're trying to do. So we see more bike lanes today. We see more, it's getting more expensive to park downtown and stuff like that. Now, let's talk about the new permits for multifamily. We're going down. The interest rates are higher. People get afraid. We just changed our president, so that also changed everything. The construction cost is super expensive. So these are the number of permits that we have had in past. So the numbers are going down. Okay. There's less.
This is across the US?
No, this is just San Diego.
Oh, wow. Okay.
This is just San Diego. Okay. Now, so this is a total number of houses that have been completed. Some of these projects takes a year, like more than 2 years, and others take a year average. Okay. So a lot of people that had a loan during COVID, they're able to finish the project pretty easily because the interest rates were low and they have a lot of money. But to finance a multifamily project is coming a little bit harder, okay, today. Now,
And by the way, multifamily project, you're referencing like a contractor, developer to come in and say, I'm going to build 5 units or larger on
more.
one lot. So that's what you're considering multifamily.
Yes.
Okay, cool.
Okay, so this is us. Okay. So we are not permitting enough housing right now. Austin has permitted more units than us. We're supposed to be faster, but it becomes so, the cities have become so uptight of all the restrictions that it's taking forever to pull something. Okay.
Got it.
Okay. So this is the average time to do a completion of a multifamily apartment building. So you see the numbers are going up. It's taking longer. So of course, interest rate, construction cost, the permit cost and time and inspections to get something done.
Got it. And this is also, if you go back to SLED, it's basically showing that back in the 90s, there was less laws. And then over time, there's more laws. So then it just takes, went from ballpark 9 months to now we're at 17 months ballpark.
And you can see after 2010, let's recover, let's move on, let's be faster. You can see that dip and then just okay, let's slow down again.
Got it. Okay, I see that.
So this is the trend. We are decreasing the number of units we are permitting right now. Okay. This is what we permitted in 2021, 2022, and 2023. We haven't had the results of 2024. Now, this is a lot of the projects that are permitted, sometimes they never finish them. I've seen projects that we were about to pull the permit, but the interest rate changed and the developer said, you know what, the numbers are not there anymore. Let's stop the process. Okay, so finally, there's new laws that are coming, especially what happened in LA. You can build your house to be fire rated resistant. And also a lot of insurance are going to look at that. So if you have fire rated assemblies on the walls, even if you don't need them, if you have steel roofs or tile that is not flammable and fire sprinklers, it will be easier for you to get an insurance and your house will be more secure. Okay, so those are the things that we need to check in the near future. And there are also already people trying to see if they can build with brick or with CMU blocks or a new material that is not flammable. So right now, just coming back to this graphic, one of the problems I had a lot is a lot of clients, they are waiting for a loan to start the design and permit process. And Arturo can tell you this, it's easier for a lender to lend money when the permit is ready. And when you are waiting to get a permit, the lender is like, I cannot give you any money. I don't have a project right now. I cannot give you the loan. So if you know you want to do a project, start the process right away. This can take 6 months to a year to get a permit. Okay, by the time you pull the permit, all the tax incentives that Jesse is saying, all the loans is easy to get it done. People may think it's a lot of money to do the permit. It's a lot of time that you're going to lose by the time you wait for a loan. So you should start your process right away.
Cool. All right. Cool. Awesome. Thank you. Thanks for the presentation. I'm going to go with speed round, ask you some questions, okay?
Sure.
First question. LA, I heard LA approved ADUs in 10 days. True or false?
I don't know.
Okay.
I haven't permitted in LA.
All right, next one. I heard City of San Diego has 5 ADU models you can choose from, and the permit process is only 2 months.
They're supposed to be 2 months. And sometimes those prefab or pre-approved plans don't fit all the projects that you have. Sometimes you don't have enough space or they don't fit where you want to do that. So you
Mhm.
need to find the right place in order to make them work. And also the design is not great. So a lot of
Right.
people look at the design and they want to change it. And as soon as you start changing it, it will take more time.
Understood. Okay. Next one. Coastal Commission adds a year to permits.
Yes.
Yes. Okay, great. Can you discuss the transit priority areas in coastal zones and when the Coastal Commission will adopt SDA? Also, what changes will happen when SDA is adopted? It's more of a technical question, but if you want to like sum it up to where people could understand.
Okay, yeah. So basically, there's two type of coastals. Okay, there's the coastal commission and the coastal high limit. So the coastal high limit, you don't have too much issues. Basically, you just cannot build something that is 24 feet high. But when you have a coastal commission, it depends on which city. It can become really complicated. So the TPA, the Transit Priority Area, is supposed to allow you to do more units. But the coastal commission in some communities are really tough. And if you're blocking somebody's view, you cannot even get a permit sometimes. And also depends on how much you are changing the project. If you're changing more than 50% of the facade of the permit, you will go to the coastal commission. If
Cool.
not, you won't. Now, when you're closer to a TPA, you're not required to have a lot of parking. There's communities like Pacific Beach. They want you to build without parking because they want people to push them to have a bike. So every single municipality will become different.
Okay.
Okay? But
Cool. Thank
normally
you.
the rule of thumb is another year if you're in a coastal area.
Cool. Last question. If you have a duplex in El Cajon, again, more technical question. If you have a duplex in El Cajon and want to add 1 or 2 ADUs to it, how long would it take to get a permit, assuming normal process? And is it fairly easy since we have a high demand for housing? Question mark.
Takes like 6 months.
Yeah.
Okay? It's not
Eh,
that long. El Cajon is, you need to go in person. They don't pick up the phone that fast and they don't respond to emails. But if you go constantly, you can get the permit in 6 months and it's not that complicated. For me, 6 months is not too much time.
Cool. Awesome. Thank you so much. And if you guys have questions, just type them in the chat. We'll get to them. Abe will get to them. All right. Thank you, Abe. All right, so now it's my turn. I'll make it short and sweet. Why? Because I got to go play basketball at 8:30 and it's 7:53. Thank you guys for holding on to this point so far. Here we go. So that's me. And let's talk about housing inventory. So I'm going to go over what's been going on. Look at uh, today, 3,880 homes on the market. Last year, same time, 2,300. So guess what? We gained 1,500 homes. That's a 64% increase. That's pretty wild. So what this is telling me is that more sellers, just like Art said earlier, they're okay getting rid of their 2 and 3% mortgages. They're going to start coming on the market. There's going to be more inventory. So if you're a buyer, guess what? You have more homes to choose from. Food for thought, 7,000 homes is normal. We're at 3,800, about half of that. And when you think about the market crashing, we need 16,000 homes. That's what happened in 2008. We're not nearly close to those 16,000 homes or 10,000 homes or anything. We're barely at 3,880, which again kind of shows me that people are okay with getting rid of their mortgage payment as long as their lifestyle changes to their satisfaction. Buyer demand last year versus this year. Last year there's more escrows than today. It's hard to put deals together. I think that's kind of what's been happening. Um, uh, Affordability is one of them, but there's been a 10% decrease year over year as far as like demand, number of buyers that are out there getting into escrow. Market time, we're at 40 days. Last year, we're at 37 days. So the market time crept up. Anything under 60 days is considered a seller's market. So it's not a buyer's market yet, but we are seeing buyers, again, get concessions and better deals than before. Okay, what happened over the last year in price? The medium sales price went up $35,000. And by the way, this 875 number last year went all the way up to about 900,000, but it came down since. So compared to the last 12 months, we had a $35,000 increase. That's a 4.17% increase in price. So if you would have bought a house even a year ago when you thought we were at the peak and when you thought it was unaffordable, you would have made some money. Food for thought. The median sold price back in 2006 and 7 was 500,000. And that's before the crash. So people were buying homes for 500,000. And I remember selling homes back then and I was thinking, man, this is expensive. I don't know how people could afford this. And right now we're at 875,000. So the lesson I learned there was never think that where you're at in this point in time is the highest that it's going to be, because it just keeps going higher and higher. Interest rates, we're not going to cover that just because Art already covered that. Now, what we will cover is this. 22%, this yellow box here, 22% of all households have a 3% interest rate or lower. Okay. Last year, that number was 25%. So it actually, people are letting go. So about 3% of the people let go of their 3% or lower interest rates. Now, 59% of all households have a 4% or lower interest rate. Again, last year, this number was 65%. So again, more people are letting go of their low interest rate loans. And then the last thing is 40% of households have no mortgage. Last year was 42%. So we're seeing those people that had no mortgage now refinance and get a mortgage because they want access to cash, so they could pay their casino debt. All right. So here we got 42 distressed homes in January. What does that mean? 42 people in foreclosure. Is that number big? Well, in a county of 3.2 million people, it is not. And this is just a cycle of how we could get to this real estate recession like we got in 2008. And really what we need is we need an expansion. We need a lot of construction, which again, in California, Abe showed us it's really hard to build. And then once we overbuild, then we go into this quadrant right here, top right, phase 3, where we have a hyper supply of properties for sale. And then that's what throws us into a real estate recession right here in phase 4. But we're not in phase 3 yet. We're trying to get there, hopefully. And so there's no way that we're going to get into the real estate recession. So when people say, hey, prices are going to drop and it's crash and this and that, like I don't see it personally. And foreclosures now, this is interesting, but not that interesting. We doubled. We're at 42 foreclosures this year in January compared to 12 months ago. We were only at 22. So it doubled, but still that number isn't high considering during the peak of the foreclosure scene in 2008, 2009, we were foreclosing on 4,100 homes a month. Right now, we're only at 42. So we're not even close to that.
Well,
Okay.
wasn't that last year also a function of the tail end of the COVID relief and the moratorium on foreclosures?
Correct. Yeah. So that had something to do with it too. It's really hard to get into foreclosure when there's laws against it, right?
Mm-hmm.
And then going into San Diego equity, number of properties that are paid off, 40% nationally. In San Diego, it's 31%. Now, compared to 3 years ago, San Diego is actually doing good. There's 1% more people paid off their mortgage. Total equity, 66% of all homes have at least 50% equity or more. That's in San Diego. Only 1.8% of all homes in San Diego are underwater or don't have equity. They're negative equity. And then positive equity, 90%, 9 out of 10 homeowners have at least 20% positive equity. So that's a great sign in San Diego. A lot of people have equity. Prices just went through the roof these last few years. Rent prices. I'm going to cover this box right here on the left. Rental occupancy rate, 93.64%. What does that mean? That means that almost 7% vacancy rate. So almost 7% of all units are vacant. Rent, check out the rent spike. In 2019, we were at 1590 on average in rent. In 2023, we're at 2338. Look at how much it jumped. And then last year it dropped 7% to 2170. So what we saw between 2019 and 2023 was just like a ridiculous increase in rents. And then what we saw between 2023 to 2024 is we saw a correction. We just saw people saying, man, rents are so high, we can't afford 2338. So let's shack up together, right? So we saw individuals partnering up and their roommates all of a sudden, right? Or kids going back to their parents' house. And that's why we saw vacancy increase, like we talked about earlier. And then that created an opportunity for rents to drop. So, it is a little bit soft in the rental market. It's harder to get qualified tenants to rent your place, and tenants are pickier because rents are dropping. Now, a little side note here, I said it may be risky to purchase investment properties based on Airbnb income. There's a lot of people doing Airbnbs. Just beware that the income could potentially be impacted with Airbnb, especially in other markets too. San Diego is still kind of strong, but this is a one-bedroom medium rent price between 2023 and 2024. San Diego, we were at 2,400 and 23, and then in 24 we dropped to 2,350. So we lost $50 on the medium rent price year over year. So again, we're seeing rents take a little hit. Construction, Abe talked about that, so I won't. What I'm going to talk about is the opportunity. Okay, there's a lot of opportunity. This is what I'm doing with my money. That way, you guys know what I'm doing with my money. Number one is borrowing money now and paying it back in 30 years. So let's talk about that. Check this out. If I kept $1 million cash without investing it over 20 years, so just say you have $1 million and it's sitting in a savings account, and the average inflation rate was 2.9% annually, which it is, according to the federal government. Over the last 20 years, it was 2.9% inflation rate. How much purchasing power will I have 20 years from now? So the answer is 569,000 in today's dollars. So basically, if you have $1 million, you're not doing anything with it. 20 years from now, it's only worth 569,000. Why is that important? Well, because you're losing value of about $430,000. So what does that mean? That means that when you borrow a bank loan and they let you borrow $1 million today to buy a house, they're the losers in this situation and you're the winner, right? Because you're getting an asset, a house that's worth $1 million. They're getting paid back over 20 years and they're losing buying power with that money that you're paying them back. So with that being said, inflation / appreciation of real estate over the last 20 years in San Diego has been 187.5%. So what does that mean? So over the last 20 years, real estate went from on average $545,000 in 2004 to $1,022,000. That's the median price for a single family home. So 20 years ago, a home cost $545,000. Now it costs $1,022,000. That's an increase of 187%. So what does that mean? If you buy a home today, 2025, for $1 million, my prediction would be that 20 years from now, it's going to be worth $2.875 million. So the opportunity that I see is you borrow on a 30-year fixed, you buy yourself $1 million home or whatever you could afford. You live there, you hold on to that property for 20 years, you're going to make a lot of money, and the bank's going to lose a lot of money. Okay? So that's opportunity number one that I see. Opportunity number two is ADUs, just like Abe said. I'm going to give you a quick example of an ADU project that I did. This is it, right? I had some garages, 1, 2, 3 garages above some apartments that I own. And what did I do? This is the inside of the garage. It looks like a garage. I started just framing it up. I got some permits. And now I have a a beautiful 1-bedroom ADU. Okay. Here's opportunity. It cost $100,000 to build. My tax basis, and here are the numbers, goes up $100,000. That's what I pay in property taxes. So my annual tax rate goes up $1,200 a year, and my insurance goes up $800 a year, and my interest payment, because I borrowed this 100,000, just like I told you, borrow money right now. My interest payment is $10,000 annually. The property manager charges me this much. So my total monthly payment to build this ADU adds an additional $1,186 a month to my expenses every month. However, the rent, $865, the expense, $1,100. So my profit is $679 a month, or $8,148 a year. So if I'm earning $8,100 a year on one ADU, I want to build as many ADUs as possible in my backyard or convert garages. Because if multiply that by 10 ADUs, that's $81,000 a year of free and clear income, right? Now, what does it do to my pocket? Well, it increases the value of the property, right? If we use a cap rate of 5%, it increases the value of my property by $304,000. If we use a GRM method, it increases it by $290,000. So on average, the value that it created was $300,000 minus my cost of $100,000. I just made $200,000 profit. So why wouldn't I build a bunch of ADUs if I'm making that type of money? And then the last, I guess, opportunity is San Diego real estate market. I think the prices will stay strong. So I always ask people this question: how long are you looking to live in San Diego? And if they answer me anywhere between 8 years or more, I say you have to own your real estate. If they say I'm going to move in 5 years or 6 years or 7 years or 4 years, then I say, okay, it's cool if you rent, because you'll make more money renting than owning. So ask yourself that question: how long am I going to live in San Diego? And if the answer is 8 years or more, you need to own your property and you need to buy more property. The next thing is, I'm just going to cover how expensive is it. Well, last year you bought a $840,000 home. That was the medium price home last year. Your payment was $4,800. This year, the medium price home is $875. Your payment's $5,400. That's a $600 swing. I mean, that isn't cheap. But the longer you wait, that's what's going to happen. So you guys spread the news to your neighbors and everybody. I'm going to skip out on some of this stuff, but I will leave you with this. Please scan this. Leave us a review if you found this interesting or helpful or whatnot. That way people could trust us online and they could see that, we're legit. With that being said, I would say that that's probably the last slide. You could follow us online. If does anyone have any final questions before we wrap up? All right. Well, you saw the opportunity for 2025. I think everyone has access to that opportunity. And 2026, we're going to be in the same position where we're talking about prices being higher than 2025. The cost of buying is going to be higher. So I would say that everybody, if you can, jump in. Prices aren't going to get any lower. You saw what Abe had to say about construction and how difficult that is. And my average point per game, it just depends on which league I'm playing in, and he's talking about
You're gonna be on the
basketball.
bench today.
I'm going to be on the
He just
bench.
gets beat up.
Yeah, I do. But hey, thank you guys for
The
jumping
better
on.
question is, how many scratches do you get per game?
I get a lot of scratches, but
Everyone's commenting. Well, I wanted to remind everyone about Coffee and Cash happening February 12th at 8 a.m. at Provecho Coffee. And our next workshop is an in-person workshop here at the office, keys to home ownership. So if you know anyone looking to get in the market, it's a great workshop to get educated.
cool. And with that, thank you to all the presenters. You guys did an awesome job. Thank you so much. Claudia, amazing job. Vanessa, too. Thank you guys, and then we'll see each other soon. Peace.
Best water boy.
That's me.
Art said that. Okay, I shut it.